Hi everyone. I trust that you are safe, that you are well and keeping safe. Welcome to the second topic, the second lesson of financial statement analysis, that is understanding financial statements. So this unit is all about analyzing financial statement analysis. Yeah. And so the course that you're undertaking at the moment is financial statement analysis, which involves analyzing financial statements. So therefore, on this basis, we need to come from the background of understanding financial statements. So we need to remind ourselves, we need to refresh on the various types of financial statements that are prepared by businesses. So we look at each one of them. So we have the income statement. Yeah, the income statement is otherwise also known as the trading and the profit and loss account, and it's generally prepared to show the profit of a business. So it shows the gross profit, the net profit, the income tax. It shows the revenues, the expenses. It basically shows the revenues, the profits that have been generated by a business within a particular period of time. And then you have number two, the second financial statement, that is a balance sheet, which is also known as the statement of financial position. Yeah, it shows the position of a business as on a particular date. Yeah, that on this particular date, the business had these assets, this amount of liabilities, and this amount of equity. That's a balance sheet. And then you have the third financial statement, known as the statement of retained earnings. Yeah, the statement of retained earnings, also known as a statement of changes in equity. If you remember, in partnership accounts, we have that financial statement being referred to as a profit and loss appropriation account. So the statement of retained earnings or the statement of changes in equity shows the items that affected the amount of owners' capital, the shareholders of the business. So the statement of retained earnings shows the items that affect the shareholders' capital. And then you have the fourth financial statement that we look at is the cash flow statement. So the cash flow statement shows the sources and uses of funds. So how cash came into the business and how it left the business. So we shall look at those financial items in details, or rather we shall try and remind ourselves of these four financial statements. So we begin with the first one, the income statement. So yeah, the income statement, as you all know it, is a financial statement that shows the profit or loss of a business for a given period of time. It shows the profit or loss of a business for a given period of time. Yeah, it's also known as the trading and the profit and loss account. So we can we can remember that there are various types of profits that they are shown in the income statement. We have the gross profit, we have the net profit. Yeah. So the income statement also shows the revenues and the expenses. So let's move on to the key items in an income statement. The following are commonly found in the income statement. One, there must be a heading. There must be a header. So in the header, we have the legal name of the business must be shown. Yeah, the legal name of the business for which this income statement is being prepared for has to be shown in the header, and then the type of the statement also be shown. So in this case, being the income statement or the trading and the profit and loss account, and then also needs to be shown in the header is the period of time for which this income statement was reported. So the period is in most cases usually on an annual basis. So for instance, the income statement may say that is the income statement of, say, Kenya Power and Lighting Company for the year ended 31st December 2016. So for a header to be complete, it has to state the name of the business. It has to state the type of statement, financial statement, and it also has to state the period for which this financial statement is being prepared. The other key element of an income statement is revenue. Yeah, an income statement is there to show profit or loss. So how do we calculate profit? Profit is basically simply revenue minus expenses. So as such, revenues are a key component of income statement. So revenues are of many types. We have the direct revenues like sales, and you have also have other operating revenues like interest, income on savings, maybe dividends on what? Dividends on shares invested by the company, and so on. Even rent income. The business may have let some of its premises to other persons to use. So incomes may be many. So revenue or incomes are also a key component of an income statement. And then you have the cost of goods sold, which is a direct expense. Cost of goods sold, as you all know it, is equal to the opening stock plus purchases minus the closing stock. That is for a trading company. For a manufacturing company, the cost of goods sold shall be equal to the opening stock plus manufacturing cost minus the closing stock of finished goods. Yeah, so I think you've done manufacturing accounts. I think probably when you are doing financial accounting, that is after doing bookkeeping, you did financial accounting or principles of accounting too. I think in this topic, you most likely covered the manufacturing accounts. So you can refer to that unit and find out how the cost of sales of a manufacturing account is done. Yeah, I think it's simply the opening stock of finished goods add manufacturing cost less the closing stock of finished goods. So the cost of sale is also a key component for in an income statement. And then another key component is the gross profit, which is simply sales minus cost of sales. I think I need to not to explain further. And then we have operating expenses of a business. Yeah. So all the other expenses apart from the direct expenses of the business. The direct expenses are those which can be directly traced to the final product. Yeah. So a good example of a direct expense is cost of sales. Yeah. Yeah. Those sales that can be directly traced to the final product. Yeah. So looking at the product, it's easy to tell that the items that have been incurred on this product. So let's say direct materials. So if it is a piece of chair made of wood, you can easily tell that there is wood on that chair. You can easily tell that there's a nail there. You can easily tell that there is paint on that chair. You can easily tell that there's a cushion. You can easily tell that there's a carpenter who worked on this. So those are direct expenses. So direct expenses are usually covered in the cost of sales. Whereas uh, uh, in the operating expenses, other operating expenses, in this case, you're referring to indirect expenses, which cannot be directly traced to the final product. A good example, still referring to that piece of chair, is the cost paid to the CEO of that company that produces those chairs. You cannot easily tell the service of the CEO on that piece of chair. Yeah, you cannot easily tell the service of an accountant on that piece of chair. You cannot easily show the cost of, say, printing and stationery on that piece of chair. So the salary is paid to the CEO, the salary paid to the accountant, the amount paid for printing and stationery are indirect expenses. They cannot be traced to the final product, and as such, they are grouped under operating expenses. So operating expenses can be classified into two. We have general expenses. This is where, general administrative expenses. Yeah, like the salary is paid to the guys working at the offices. Yeah, the CEO is working at the office. The accountant is working at the office. He's not working at the factory to produce that product. Yeah, so general administrative expenses, which may also include printing costs, rent of the office, lighting of the office, and so on. And they also have selling expenses. Yeah, a good example of a selling expense is advertising costs. So these indirect expenses will fall under operating expenses. And then you have total net operating income. So the net operating income is usually equal to the gross profit minus operating expenses. The gross profit minus the operating expenses. But if there were operating incomes other than sales, they can also be included to determine the net operating income. So if there are other operating incomes, then the net operating income should be will therefore be equal to the gross profit plus other operating incomes minus other operating expenses. It will give us the total net operating income. Yeah, so the net operating income is another key component of an income statement. And then another key component is other revenues and expenses. Yeah, so in this case, as written here, these are incomes and expenses that are not generated in the usual operations of the business and that cannot be considered to be extraordinary. So we need to differentiate other revenues and expenses from extraordinary events. So in our case here, we are looking at those incomes and expenses that are not generated by usual operations of a business and that are not considered extraordinary. Yeah, like a good example of another expense is financial expense, interest expense. Yeah, so assuming this is a business that produces chairs, yeah, it's in the furniture industry. So the furniture industry is quite different from the banking industry. So a furniture company paying financial expenses, yeah, this financial expenses, interest expense is not what is not the normal operation of the business. The normal operation of the business is to produce furniture, but not to pay interest. So it's not, the business is not a bank, but a furniture business. So when the business engages in financial services and paying for financial expenses, then this financial expense is another revenue which is not part of the normal operations, but takes place on a regular basis in the business. So other revenues and expenses, such as financial expenses and interest on investment, need to be listed separately in the income statement, yeah, so as to report their effect on the profit of the business. So therefore, other revenues and expenses are also a key component of an income statement. And then we have pre-tax income, that is income before tax, yeah. So that is, it will be equal to the net operating income less other operating revenues and expenses in net form, which will give us the pre-tax income. So the pre-tax income is equal to the net operating income less minus other expenses plus other revenues. It will give us the tax before the income before tax, yeah, before we deduct tax. So then after pre-tax income, we deduct tax, yeah. So then we get the income tax, so it should also be a key component of an income statement. And then we have extraordinary gains, or so that is an extraordinary gain stroke loss net of income tax, yeah. So therefore we also have another key component of an income statement is extraordinary gain or loss. And the next extraordinary gain or loss should be reported separately in the income statement net of the tax effect. So an extraordinary event is any occurrence that is highly unusual in nature and could not be foreseen and is not expected to recur. Yeah, an extraordinary event is any occurrence that is highly unusual in nature and could not be foreseen and is not expected to occur. So say for instance, in our furniture company, it happened that a multinational decided to set a base in Kenya. So a big organization, say Microsoft, decided to come and maybe establish a regional office in Nairobi, yeah, and then it appointed the furniture company to furnish it with furniture, yeah. So you would expect that Microsoft would buy a huge chunk of furniture, yeah. So this is an event that has just taken place just once when Microsoft decides to set base in Kenya. But during the other periods, the business has not been operating has only been dealing with small customers who only come and get one unit. Yeah. So when Safaricom, Microsoft comes and takes a huge chunk, this is not something that still is expected after during the other normal periods. So it's expected that maybe the business's operations are expected to return to normal in other years. So the event of Safaricom, Microsoft coming is an unusual event, which will benefit the business to a great extent. So this great benefit is an unusual gain to the business, and it needs to be reported separately. Or say, for instance, in the event of maybe a major loss, an unusual loss, say the event of what? Of the event of fire. So the fire comes and ravishes the factory or the store or the warehouse, and all the furniture is gone. That's a loss to the business. Yeah. So that's also another unusual event. It's not always that we expect that there will be a fire on a daily basis or every year. So when this fire comes, yeah, at a given chance, this fire will result to a loss to the business. So this loss needs to be reported separately in the income statement. So it's reported as an extraordinary gain or loss. And these extraordinary gains or losses should be reported net of their income tax effect. And then we have the final item in the income statement, that is the net income. Yeah. So the net income or profit is usually referred to as the bottom line. Yeah, that is the net profit. So the last item in the income statement. And then we have the earnings per share. This is basically a ratio. We shall look at it when doing the ratio analysis. Remember, we talked of the 5 pillars of ratio analysis. Among them is the market ratios, where the earnings per share falls. So the earnings per share is a ratio. It's obtained by dividing the net income divided by the total outstanding common shares. Yeah, usually the earnings per share is equal to the net income divided by the total shares of the business. So, and with that, my friends, we have the income statement. So we have an example, an illustration of how an income statement should look like. And since this is basically a refresher to you guys, I won't dwell into the preparation of an income statement. So please refer to the previous units on how to prepare an income statement. So I expect that at this point you know how to prepare it. So we have an example here. We are given these details. We expect to present them in the format of an income statement. And below there we have an income statement. Yeah, it must have a title, but this one is wrongly done. Yeah, so you see that in the heading there must be the name of the business, and then the type of the income statement prepared, and there has to be the period for which that income statement has been prepared. Then we have the revenues, we have the cost of goods sold, we have the gross profit, we have the operating expenses and incomes, which will give us a net operating profit. Then we add net operating non-operating income less non-operating expenses, and then we get the net profit, assuming there are no extraordinary gains or losses. Yeah. Next, we move on to the next financial statement, that is the balance sheet. But before we move there, we look at the presentation of financial statements for analysis. We have two main ways of presenting financial statements. That is a vertical approach and the horizontal approach. So the vertical approach presents the particulars, the items in the financial statement in a single column. Yeah. Whereas the horizontal approach has two sides. It has two columns for presenting the particulars. So say for instance, in a balance sheet, have a balance sheet here. This balance sheet is presented on the horizontal approach. you can actually see that there are two sides. Yeah, two sides, this side and there is this side. Yeah, so here we have the particulars in this column, and here we now have other particulars in another column. This is a horizontal approach. Yeah, so something that is prepared like a landscape. Yeah, we have two sides. Yeah, whereas the vertical approach is like this one, whereby you have everything, the particulars in a single column. Yeah, so this is a vertical approach. So back to where we were. So the presentation of financial statements for analysis. So there are two. We say that there are two types approaches of presenting financial statements. That is a vertical approach, the horizontal approach. When it comes to analysis of financial statements, yeah, we said in our previous topic that comparability, financial statements should enhance the comparison. That is, we are able to compare the performance of one business over time. So it's easier to compare the performance of a business over time when we present the financial statements in a vertical format. So the vertical approach is usually preferred when in analyzing financial statements. Yeah, you will find it even through experience, because it's easy to you can so like in our balance sheet here, in the vertical approach, when you want to compare the performance of this business over time, you only need to input these particulars in one column, and then we have another particular column here for say year 1, another column for year 2, another column for year 3, another column for year 4. So it will be easier that way to compare when presenting the financial statements in the vertical format. So therefore, in this case, we are presenting our financial statements in the vertical format. Yeah. So then next we move on to the balance sheet. It's something that you all know. Yeah. So the balance sheet is also known as the statement of financial position. Yeah. It shows, it's called a statement of financial position because it shows the position at which a business was at a particular time. Yeah, at a specific time. So on this particular date, the business had these assets, it had these liabilities, and had this capital. Yeah, so therefore we can say that a balance sheet is a financial statement that records the total assets, the total liabilities, and the equity or net worth of a business on a particular day. So a balance sheet will follow the normal accounting equation. That is, asset is equal to liabilities plus equity. Also can be transposed into assets minus liabilities is equal to equity. So that is to say that the key elements in a balance sheet is the assets, the liabilities, and equity. So we look at the elements in this in a balance sheet one by one. We have one, there must be a header. So and in the header, the legal name of the business must be there, the type of the financial statement, in this case the balance sheet, and then lastly, the date of the balance sheet. And then we have another key element is the assets. We all know what assets are. These are resources that are controlled by the business, out of which benefits are expected to flow to the business. And assets are mainly classified into two. We have current assets, those which can be converted into cash within a year from the date of the balance sheet. Examples of current assets is accounts receivables, also known as debtors. We have stock or inventory. We have temporary investments. For example, investment in marketable securities like share in like treasury bills, yeah, issued by the government. And then we also have prepaid expenses as examples of current assets. And then we have fixed assets, those which are expected to be held by the business for periods exceeding a year from the date of the balance sheet. Examples, we have land, buildings, furniture, motor vehicles, and etc. Then we also have other assets. In this case, normally referred to as intangible assets. Yeah, intangible assets like goodwill, trademarks, and patents. And then another key element in an income in a balance sheet we have is liabilities, as we have seen in the equation. So liabilities are also classified into two. We have current liabilities, those which are expected to be paid within a year from the date of the balance sheet. Examples of current liabilities, we have accounts payable, also known as creditors. We have short-term debts. We also have the current portion of a long-term debt. We have interest payable. We have taxes payable, and we have accrued expenses. An example of an accrued expense could be, in this case, accrued wages and salaries. And then we have long-term liabilities, those which are expected to be cleared within a year, within periods exceeding a year from the date of the balance sheet. And then lastly, we have equity. Equity is the owner's claim in the business. Yeah, it's also called the net worth. So it's the claim of the owners in the assets of the business. So in equity, we have shareholders' capital. Yeah, that is the company's shares, the share capital, also known as the capital stock. We also have the treasury stock. Treasury stock result when a company buys back its own stock or shares. Yeah, it's like the company investing in itself. Yeah, so the company buys its own share. Say a company like Nation Media Group buying shares of Nation Media Group, investing in yourself. The company is investing in itself. So these are known as treasury stocks. They also form part of shareholders' capital. And then we have retained earnings. Retained earnings is that part of profits that remains after dividends have been paid to the shareholders. So retained earnings is another component in the owner's equity. So we have an example of a balance sheet. Yeah. So on one side we have share capital, and we have long-term liabilities represented by fixed assets and working capital, of which working capital is comprised of current assets and current liabilities. So that is an example of a balance sheet. Then we have another financial statement, in this case referred to as a statement of changes in equity. These are financial statements that shows the items that affect the equity of a business. Yeah, the items that increase the equity of a business. So equity is most cases simply for trading, sole proprietorship is affected by net profit and drawings. So the net profit increases the equity, drawings decrease the equity. For companies, we have equity being affected by, okay, the net profit. So in this case, we refer to it as retained earnings. So retained earnings are those profits that remain after dividends have been paid. And then that was retained earnings. And then another item that affects equity for a company is dividends. Yeah, dividends is distribution to the shareholders. So for a sole proprietorship, we talk of drawings by the owner. But for companies, we talk of dividends that are being distributed to the shareholders. So, and then after dividends have been distributed, we end up with a closing balance of equity. And then we also have some reserves in the equity. So you have an example of a statement of changes in equity. In this case, we have share capital. Yeah, that is the owner's claim, the amount that has been invested directly by the owners. And then we have reserves. Yeah, so these reserves are attributable to the owners of the business. And then we have retained earnings of the business. Retained earnings are affected by distribution to the shareholders. So in this case, in form of dividends. And then in the end, we have the total equity at the end. So the total equity is made up of share capital plus reserves. Yeah, it's made up of share capital plus reserves plus plus retained earnings minus the distribution to the shareholders, in this case in form of dividends. So, and that is is a statement of changes in equity, which is also known as a statement of retained earnings. In partnership, it's referred to as a profit and loss appropriation account. And then lastly, the fourth financial statement is a statement of cash flows. Yeah. So this is a financial statement that shows the inflows and outflows of cash in the business. Yeah. It shows how cash has been used and how cash has been generated by the business. So the statement of cash flows is divided into three parts. So we have cash flows from operating activities, we have cash flows from investing activities, and we have cash flows from financing activities. So we shall look at an example of preparing a cash flow statement analysis, a cash flow statement. So we have two main ways of preparing a cash flow statement. We have the direct approach and we have the indirect approach. So in our case, we shall look at the direct approach of preparing a cash flow statement. And these are the formulas of preparing cash flow statements arising from operations using the direct cash flow technique. So we shall have an example to illustrate this. So please note these formulas. They are quite easy to understand. Yeah. So you only need to understand these approaches, and you are good to go in preparing a cash flow statement. So, like for instance, the cash flows from customers, they are obtained by having sales plus opening balance of debtors minus closing debtors. Whereas cash flows to suppliers, we have the payments to suppliers is equal to the cost of goods sold plus ending inventory minus closing stock plus opening creditors minus closing debt creditors. Also, the payment to suppliers in case we have purchases. The payment to suppliers will be equal to purchases plus ending closing stock minus closing stock plus opening creditors minus closing creditors. So note the difference between these two approaches. When you're having cost of goods sold, we add ending inventory and then we minus beginning or opening stock. But when you have purchases, where is the difference? Please note the difference. Yeah, okay, they are all the same, yeah? So we shall have an example to illustrate this. Then we have cash paid to employees will be equal to wages expense plus wages payable at the beginning minus wages payable at the end. And cash paid for expenses shall be equal to expenses plus closing prepaid expenses minus opening prepaid expenses plus beginning prepaid expenses minus plus beginning accrued expenses minus ending accrued expenses. And then cash received from revenues, so shall be equal to the revenues plus ending closing incomes in advance minus opening incomes in advance plus beginning accrued incomes minus ending accrued incomes. And for interest received, the receipt from interest shall be equal to the interest income plus beginning interest receivable minus closing interest receivable. Then we follow the same procedures for the other items. So we shall have an example to illustrate this. So, and with that, then have an example.